Markets are on high alert, volatility is ticking up with the VIX at 18.4, non-farm payrolls is looming, and sectors like tech, healthcare, and finance are making big moves, setting the stage for a pivotal week. Stay with me, your complete market intelligence briefing starts right now. The market experienced a mixed performance this week, with the S&P 500 declining by 1.59% and the NASDAQ falling by 3.32%, while the Dow managed to gain 0.32%. The VIX, a measure of market volatility, rose by 6.54% to 18.41, indicating a slight increase in risk appetite. The 10-year yield decreased by 3.04% to 4.37, and the US dollar index was relatively stable, down 0.05% to 101.36. The week was marked by a rotation out of technology stocks, with the sector declining by 4.5%, and into healthcare, which gained 7.8%. The energy sector also saw a modest increase of 0.85%. The gold price fell by 2.85% to $373.63, and oil prices dropped by 6.4% to $105.48. Bitcoin declined by 2.54% to $59,446.62. The VIX is signaling that market participants are becoming increasingly cautious, which is consistent with the normal conditions of the current market regime. The top performing sectors this week were healthcare, real estate, and utilities. The overarching theme of this week is the sector rotation, with investors moving out of growth-oriented sectors and into more defensive areas. The upcoming non-farm payrolls report could potentially shift market sentiment. Now let us go sector by sector and break down exactly where the opportunities and risks lie. Technology sector performance was notably weak this week, declining by 4.5%, with a month-to-date loss of 3.04%, driven largely by a broad market sell-off, with key names such as AAPL, MSFT, NVIDIA, Jojil, and Meta feeling the pressure. This sector, encompassing tech, semiconductors, software, and AI, is highly sensitive to general market conditions, which were unfavorable this week. The Relative Strength Index, or RSI, is at 45, indicating a bearish trend, and a bearish signal overall. Watching these key names closely is crucial, as they can heavily influence the sector's direction. The key risk this week remains the overall market sentiment, which can quickly turn these stocks around. Given the current technical reading, investors may want to exercise caution and consider a more defensive positioning, keeping in mind that this is educational content and not financial advice. Healthcare sector performance this week has been quite impressive, with the sector ETF gaining approximately 7.8%, bringing the monthly total to around 8.24%, indicating a strong bullish trend. The Relative Strength Index, or RSI, is currently at 68, which suggests that while the sector may be approaching overbought territory, the trend remains bullish. Johnson & Johnson, United Health Group, Pfizer, AbbVie, and Merck are key names to watch in this space, given their significant influence on the sector's overall performance. A key risk or catalyst this week will likely be general market conditions, as the sector tends to follow broader market trends. From a technical standpoint, the RSI reading of 68 suggests that the sector may be due for a consolidation. However, the bullish signal remains intact, and investors may want to consider strategically positioning themselves for potential further gains in this sector, keeping in mind that this is educational content and not financial advice. Financial sector performance was modest this week, with the sector ETF rising 0.35% and 4.55% for the month, indicating a neutral trend in signal. The sector's gains were largely driven by the strong performance of key names such as JP Morgan and GS, with BAC and WFC also showing resilience. The upcoming non-farm payrolls report is a key risk or catalyst this week, as it may influence interest rates and consequently, the sector's trajectory. With an RSI of 65, the sector is not overly stretched, suggesting a neutral technical reading. In terms of strategic positioning, investors may consider maintaining a balanced exposure to the sector, given its relatively stable performance, while also being mindful of potential market fluctuations. Please note that this is educational content and not financial advice. Energy sector performance was a highlight this week, with the sector ETF gaining 0.85%, albeit still down 4.85% for the month. The trend and signal both indicate a bullish stance, driven by the recovery in oil prices and renewed interest in renewable energy sources. Names such as XOM, CVX, and Copper worth watching, given their integrated business models and adaptability to changing energy landscape. The key risk or catalyst this week was the general market conditions, which can impact the sector's performance. From a technical perspective, the RSI reading of 41 suggests that the sector is not overbought, and there is room for further upside. Strategically, investors may consider positioning themselves for a potential rebound in the sector. Keeping in mind this is educational content and not financial advice, it is essential to assess individual risk tolerance before making any investment decisions. Consumer sector performance was notably weak this week, with the XLY ETF declining by 2.19% and a monthly loss of 5.72%, indicating a bearish trend. This decline can be attributed to concerns over consumer spending and economic growth, which was partly influenced by the recent non-farm payrolls report. Key names such as AMZN, TSLA, and Nike are worth watching, as their performance can be a bellwether for the sector. The Relative Strength Index, or RSI, is at 38, which suggests the sector is oversold and due for a potential bounce. However, with the current bearish signal, investors should exercise caution. From a strategic positioning perspective, it may be prudent to maintain a neutral stance on the consumer sector and monitor its developments closely, as this is educational content and not financial advice. Industrial sector performance was modest this week, with the sector ETF gaining 0.41%, bringing its monthly gain to 4.21% amid normal market conditions. The Relative Strength Index, or RSI, is at 59, indicating a neutral trend. Key names such as CAT, HON, and UPS drove this performance, with aerospace and logistics showing resilience. The non-farm payrolls report is a key risk or catalyst this week, as it may influence sector sentiment. From a technical perspective, the neutral RSI reading suggests the sector is not overbought or oversold, allowing for potential upside or downside movement. Strategically, investors may consider positioning themselves to capitalize on potential growth in the sector, keeping in mind that this is educational content and not financial advice. Materials sector performance was relatively flat this week, with the sector ETF declining by 0.03% and still up 1.2% for the month, indicating a neutral trend, and the signal is also neutral. The key names in this sector, such as LAN, SHW, FCX, NAM, APD, were influenced by general market conditions. What drove the sector's performance this week was the overall market sentiment, as the sector is heavily dependent on general economic conditions. A key risk or catalyst this week is the potential shift in market sentiment, which could impact the sector's performance. The RSI reading of 53 indicates that the sector is not overbought or oversold, which is a neutral technical reading. Strategically, it is essential to maintain a balanced portfolio, and investors should consider the sector's fundamentals and technicals before making any decisions, keeping in mind this is educational content and not financial advice. Utilities sector performance was notable this week, with the sector ETF gaining 3.88% and 3% for the month, indicating a bullish trend. The key driver of this performance was likely the general market conditions, which favored defensive sectors such as utilities. Stocks like NI, DUK, and so are worth watching, given their significant weight in the sector. A key risk or catalyst this week was the overall market sentiment, which can impact the sector's performance. From a technical perspective, the RSI reading of 54 suggests the sector is not overbought, supporting the bullish signal. Strategically, investors may consider positioning themselves in this sector as a defensive play, given its relatively stable performance. Please remember this is educational content and not financial advice. Real estate sector performance was impressive this week, with the sector ETF VNQ gaining 4.16% and 2.7% this month, indicating a bullish trend, supported by a bullish signal, which is a positive indicator of the sector's strength, given normal market conditions. The key drivers of this performance include the strong non-farm payrolls report, which boosted investor confidence in the sector, particularly in REITs and commercial real estate. Names such as PLD, AMT, and EQIX are worth watching, as they have been leading the charge in the sector. With an RSI of 57, the sector is not yet overbought, suggesting there may be room for further gains. From a strategic positioning perspective, investors may want to consider maintaining a long-term view on the sector, given its current momentum, and this is an educational commentary, not financial advice. Crypto sector performance was notably weak this week, with the IBIT ETF declining by nearly 5% and a staggering 20% this month, reflecting a bearish trend and a neutral signal. The downturn was largely driven by general market conditions, which had a ripple effect on key names such as Bitcoin, Ethereum, and Solana. Notably, BTC and ETH are worth watching, given their significant influence on the sector. The key risk this week was the overall market sentiment, which had a cascading effect on the sector. From a technical standpoint, the RSI reading of 30 suggests the sector is oversold, which could potentially lead to a rebound. Strategically positioning for a potential bounce, investors should remain cautious and remember that this is educational content and not financial advice, as market conditions can shift rapidly. Commodities sector performance was under pressure this week, declining by approximately 3.86%, with a month-to-date loss of around 11.06%, driven by general market conditions. Notable names such as GLD, SLV, USO, Corn, and WAT are worth watching, given their significant influence on the sector. This week, a key risk or catalyst is the overall market sentiment, which can impact commodity prices. From a technical perspective, the Relative Strength Index, or RSI, is at 29, indicating an oversold condition, which may suggest a potential rebound. Considering this, investors may want to strategically position themselves to take advantage of a potential bounce, while keeping in mind that this is educational content and not financial advice. As always, it is essential to assess your own risk tolerance and investment goals before making any investment decisions. Forex sector performance was notable this week, with the UUP gaining 0.57% and a 2.56% increase this month, indicating a bullish trend. However, the RSI reading of 76 suggests the sector is overbought. The strength in the US dollar, as measured by the DXY, has been a key driver of this performance, along with currency pairs such as Euro to US dollar, Pound sterling to US dollar to Japanese yen, and Australian dollar to US dollar. Given the current market conditions, the key risk this week is a potential pullback in the dollar, which could impact the sector's performance. From a technical perspective, the overbought reading on the RSI warrants caution, and investors should be prepared for a possible correction. This is educational content and not financial advice. It's essential for investors to strategically position themselves for potential market shifts, considering the current market regime and economic events. This week's economic calendar is highlighted by the highly anticipated non-farm payrolls report, scheduled for release on July 10, 2026, which is a crucial indicator of the labor market's health, measuring the change in the number of employed people in the U.S., excluding farm workers and a few other categories. The market consensus expects a moderate increase in payrolls, around 180,000 jobs added, which is slightly above the recent trend. A beat on this number, meaning a stronger than expected jobs report, could lead to increased speculation about potential Federal Reserve hawkishness, resulting in a stronger dollar, lower bond prices, and potential downward pressure on equities, particularly in the interest rate-sensitive sectors. On the other hand, a miss on the non-farm payrolls, indicating a weaker labor market, could lead to increased expectations of future rate cuts, which would likely have the opposite effect, with the dollar potentially weakening, bond prices rising, and equities, especially in the growth-oriented sectors, experiencing upward momentum. Historically, the release of the non-farm payrolls report has been associated with increased market volatility, with average intraday moves in major indices often exceeding 1%. The sectors most exposed to the implications of this report include finance, technology, and consumer discretionary, as these areas are particularly sensitive to changes in interest rates and consumer spending patterns. It is essential for investors to recognize that this is educational content and not financial advice, and to consider their own risk tolerance and investment objectives when navigating these market dynamics. The historical pattern suggests that the market tends to be highly reactive to surprises in the non-farm payrolls report, making strategic positioning and a deep understanding of the potential implications crucial for investors looking to manage risk and capitalize on opportunities in the current market environment. Thank you for watching Financial Market Oracle. Please like and subscribe, comment below on the sector you are watching this week. Remember, this is educational content and not financial advice. I wish you a profitable and disciplined week. I will see you next week. Stay profitable. This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.